In the complex world of investing, the decision-making process is often thought to be guided by rational analysis and empirical data. However, the reality is that social influence plays a significant role in shaping investment choices driven by psychological factors and neuroeconomics mechanisms. This video delves into the realms of behavioral finance and neuroeconomics to examine how social pressures, herd behavior, and the fear of missing out, FOMO, profoundly impact individual and group investment decisions. Social influence in investment decisions manifests in various forms, from the persuasive power of financial news and expert opinions to the subtle yet pervasive impact of peer actions. Investment analysts are not immune to these influences, as the collective sentiment and actions of others can sway decision-making processes, often subconsciously. The psychological desire to belong or to be part of a successful group can lead investors to follow trends without thorough independent analysis, potentially leading to irrational market movements and asset bubbles. Herd behavior refers to the tendency of individuals to mimic the trades of a larger group, irrespective of their own beliefs or the underlying fundamentals. This phenomenon is rooted in evolutionary psychology, where there was safety in numbers. In the context of financial markets, herd behavior can drive massive swings in asset prices disconnected from intrinsic values. While it can create opportunities for gains, especially for early followers, it also increases the risk of market corrections and crashes, as seen in historical market bubbles and panics. The fear of missing out, FOMO, is a powerful emotional driver in investment decisions, exacerbated by the instant and pervasive nature of modern communication technologies. Seeing others achieve substantial returns can lead to impulsive decisions driven by the fear of being left behind. FOMO can cause investors to disregard risk assessments in favor of speculative bets, often entering markets at unsustainable highs. Neuroeconomics, the interdisciplinary field combining neuroscience, economics, and psychology, provides insights into how social influence affects the brain's decision-making processes. Studies using functional magnetic resonance imaging have shown that social information activates areas of the brain associated with reward processing, such as the ventral striatum. This suggests that social conformity in investment choices may be driven by the anticipation of rewards, not just the avoidance of social disapproval. Moreover, neuroeconomic research indicates that experiencing financial gains activates similar brain regions as those involved in processing social rewards, highlighting the intertwined nature of social and financial decision-making. This biological basis for social influence underscores the challenge of overcoming herd behavior and FOMO, as these impulses are not solely rational but deeply rooted in human neurobiology. For investment analysts and investors alike, awareness and understanding of these psychological and neuroeconomic factors are crucial in mitigating the impact of social influence. Strategies to counteract herd behavior and FOMO include having a well-researched and robust investment rationale can help resist the lure of following the crowd without due diligence. Focusing on long-term investment objectives can help investors avoid the temptation of short-term speculative gains driven by social influence. Cultivating emotional awareness and discipline can aid in recognizing when decisions are being influenced by social pressures or emotional reactions rather than rational analysis. Spreading investments across a variety of assets can reduce the risk associated with any single investment swayed by herd behavior. The impact of social influence on investment choices is a complex interplay of psychological and neuroeconomic factors. Herd behavior and FOMO, fueled by social pressures, can lead to irrational market dynamics and pose significant risks to investors. By understanding and addressing these influences, investment analysts can better navigate the challenges of the financial markets, making informed decisions that align with rational investment strategies and long-term goals. In doing so, they can mitigate the risks associated with social influence, capitalizing on opportunities while safeguarding against the pitfalls of collective irrationality.